Okay, so to get started with this, we're going to talk about income taxes. And you have this in your notes, but one of the things we want to talk about is the difference between gross income and adjusted gross income. These are not the same. Your gross income is your total income for the year. It's your wages, your tips, your profits, your capital gains, your interest, or your dividends. That's all the different sources of kinds of income that you might have. Basically, the way that you can remember what gross income is it's everything you earn. Everything. It does not count gifts, because you don't earn a gift. It does not count insurance reimbursements, like, for example, I learned this the hard way. You don't count the reimbursement from your insurance company, like if your car gets stolen or it gets totaled. You don't count that amount they give you, because it's basically to replace something you lost. So that's not counted as income. But anything that you earn, and basically it's looking at it that capital gains are what you get from buying something and then later reselling something, like stocks or bonds, or even your, usually you can sell property, that's capital gains, but it depends on how long you hold the money after you sell the property. Now, if it's your primary residence, your home, that doesn't count as capital gains. It's interest that you earn on any money that you have either invested or put in a savings account, and it's the dividends off your stocks, unless for whatever reason they're tax deferred. A lot of people have their retirement account set up to where they don't have to pay the tax on it now, they'll pay on it later. But anything that you actually take in as in income, it's incoming money to you that you worked for in one way or another, then that's gross income. And as the notes made here, some gross income is not taxed. IRAs or other non-tax savings plans, those are called adjustments. And that leads us to the offshoot of gross income, something called adjusted gross income, which is your third definition on that page. Your adjusted gross income is your gross income minus any adjustments, such as things you didn't pay tax on, your IRA, your non-tax savings plan, that sort of thing. It also will include something called tax exemptions, and we'll look at that in the table. Now, tax deferred income, which we've mentioned, it is taxed, but it's not taxed now. Deferred means later. So it's not taxed now, but it's going to be taxed when you withdraw the money. For example, I have a retirement account, and I take a certain amount of the money that I make every month, and it goes into my retirement account. I don't pay taxes on that right now. But when I retire and I start drawing from that pool of money, then whatever I take out of that money, I will then have to pay income tax on it. But hopefully at that point, it'll be at a lower tax rate. That's basically to encourage people to save for their retirement. Your contributions to those IRAs or any other tax-deferred savings plan is called an adjustment to your gross income. Interest earned is also tax-deferred on those accounts. So not just the money that you put in the account, but the interest that account draws is tax-deferred. So the value of the account's going to rise a lot more quickly than the value of an ordinary savings account. We've got a few more definitions here. Exemptions and deductions. There is a difference between the two. Exemptions is a fixed amount per person, and in 2016 that fixed amount was $4,050. Regardless of your tax filing status, if you're single, head of household, married, or whatever, you still get a personal exemption for yourself and for each one of your dependents. So, for example, if you're the head of a household and you have 2 children, then you'll get 3 personal exemptions. Yours plus 1 for each of your 2 children. Now, the other kind is deductions. And your deductions come into 2 different kinds. The first one is called a standard deduction, and that depends on your filing status. The standard deduction is different for single people, married people filing jointly, married people filing separately, and head of household. Those are all different. Then you also have something called itemized deductions. And that's where you add up all your individual deductions, like for your mortgage, for any kind of losses you sustained during the year, or any other kind of deduction that you're allowed to have, or you're entitled. Be careful using that word entitled when you're talking about tax and government. Entitled does not mean it's mine because I should have it. Entitled means that you should have it because it belongs to you, okay, that you paid for it. And other kinds of individual deductions are, as I said, mortgage interest, and you can take tax deductions for donating money to charity. And once you get your adjusted gross income and you take off your exemptions and your deductions to get your adjusted gross income, then you have taxable income. And your taxable income, this is very important, your taxable income is your adjusted gross income, which I will refer to as AGI, minus any exemptions and deductions is going to give you your taxable income. So it's your AGI minus any of these that you have. Okay, you subtract those off before you calculate your taxable income. Now, there are some other definitions that we're going to need to look at. There's something that's called a progressive income tax. And what that means is the progressive part of it tells you that people with higher income, higher taxable income, pay at a higher tax rate. So people on the higher end of the spectrum pay a larger portion of their taxable income in income taxes. Now, when we look at the table, I'll explain that to you. Like, for example, here, people in the higher incomes, people that make over $415,000 a year and are single, anything they make over that $415,050, they're going to pay 39.6% taxes on. Whereas people that only make, let's say, $37,650, they're only going to pay 15% taxes on theirs. Okay, they make less money, so they pay a smaller portion of their money in taxes. And for anybody that thinks, well, you know, that's not fair that somebody else has to pay a bigger percentage, well, it is, because if you're making a lower amount of income, you're having to spend all of your income on housing and medical costs and food and, you know, basically living expenses. You're not going to have much left over. And people that make The higher incomes, like over $400,000, they're probably not making 10 times what you are in house payments, or car payments, or food. I mean, basically a family of four, you're gonna feed the family of four on maybe not exactly the same amount of money regardless of income, but you're certainly not going to spend 10 times as much on groceries for four people just because you make 10 times as much money. So it's a way of kind of leveling the playing field. Then we also have something we call tax credits. And a tax credit is a way that you can reduce your tax bill if you have certain kinds of credit abilities. The first one would be, and this is the most common one since 2003, you get $1,000 per child. Okay? You can get a tax credit. A non-refundable tax credit is a refund only up to the amount you owe. So let's say you have 3 children. That means you might get a $3,000 tax credit, but your tax bill is only $2,500. Well, you don't get that extra $500 back. You just don't have to pay the $2,500. Okay? You also can have what's called a refundable tax credit. And that means you can get a refund even if it's more than the amount of tax that you owe. So if you come up and your taxable, the amount of tax you're supposed to pay is $3,500, but you have $5,000 worth of refundable tax credits, then you will get not just $3,500 knocked off your tax bill, but you'll actually get the other $1,500 sent back to you as part of a refund. Now, you are going to need to know those definitions, and I would suggest to you that after we've worked some problems, maybe you get some index cards and put the term on the front and then write on back what it actually is. Don't memorize it, but know what it means. Okay? So we'll do some examples here. First thing that we have is Karen, who is single. Karen is single. That's something we're going to need to know. That'll tell us what part of the tax tables to use. So because Karen is single, that means when we get this tax table here, we're going to look on the single column because Karen's single. She's not married. And she has earned wages of $34,200, plus she receives $750 in interest from a savings account. And she contributed $1,200 to a tax-deferred retirement plan. So she doesn't have to pay taxes on that. So her total income is going to be the $34,200 and the $750. That's what she earned. So she earned $34,950. And that is her gross income. That's all the money that she earned, either from a savings or from the job that she has. Now, that is not going to give you her adjusted gross, because her adjusted gross income has to do with that $1,200. She doesn't have to pay taxes on that right now. So her adjusted gross income is $33,750. Which is what I call AGI, because I'm lazy, I don't like to spell things out. Okay? Now, when it says to find her taxable income, we found her gross income. We have found her adjusted gross income. Now what we want to find is her taxable income. Her taxable income is her adjusted gross income minus the deductions that she's entitled to. So we'll go to the tax table to find those. So Karen is single, and she is entitled to a $6,300 standard deduction. She's also entitled to one personal exemption for herself, and that's $4,050. So we'll subtract both of those off of her adjusted gross income. And that gives us her taxable income. So this is her standard deduction. And this is her personal exemption. So she doesn't pay taxes on those. So we have her taxable income. And that means then we would use that taxable income amount to calculate her income taxes. Okay? Any questions? And we're not required to calculate her taxes, so we won't do that right now. But on the next one, I think we will.
Okay, can you turn it back just a second?
See if I can adjust this so we can see the calculator and that. Okay, you ready to go? Okay. Next example says we have Sarah and Marco, and they are married filing jointly. And so that tells us that when we go to the tax tables, we're gonna look at the column that says married filing jointly. So we'll look at the second column. And when we look at that column, we're also gonna need to take into account what is their taxable income. And it's $87,500 between the two of them. So with that being their taxable income, on that table, we're gonna have to come down here and look and see how they calculate their taxes and what bracket they're gonna fall in. So the first $18,550 of their money, they're gonna pay 10% income tax on. And then up to $75,300 minus that $18,550 they've already paid taxes on, they're gonna pay 15% taxes on. And then all the rest of it falls under the 151,900, so they're gonna pay 15%, or excuse me, 25% on the balance. So here's how that works. Remember, their taxable income is $87,500. And then we have to figure out how that amount is taxed. So we're going to look at all three of these. So we're going to take 10% of the first $18,550. Then we're going to add to that 15% of $75,300 minus the $18,550 because you already paid taxes on that. And then finally, you're going to pay 25% or 0.25 times their whole income is $87,500. But they've already paid tax on this much of it. So that's the order of the calculations that we're going to do. And it looks long and drawn out, but honestly it's easier to do this if you'll actually enter it into your calculator exactly like what I just showed you. So what we're going to do to calculate their taxes is we're going to enter into the calculator 10% times 18,550 plus decimal 15 for 15% of 75,300 minus, because we've already paid taxes on it. Yes. And then we're also going to pay 25%. I'm going to drop down here so we can write bigger. Of the full amount, $87,500. Minus this full amount, because they've already paid 15% taxes on that, so they're not going to have to pay 15% plus 25%. Now, you can, I will admit this, you can break this up and do it in smaller steps. But in my experience, in this particular case, when you break it up and do smaller steps, you're more likely to make a mistake on one small step that throws off the whole thing. So the easiest thing to do is to actually enter this into the calculator all at once. So we're going to enter it in exactly the way that this says. So it's going to be 0.10, and then in parentheses, what you're going to multiply by is the 18,550 plus 0.15 times the 75,300 minus the 18,550 plus 0.25 times the full amount, because they're 87,500. And once again, the reason we're doing 87,500 is because it's actually less than the maximum amount for that category. So we're going to use their actual income. And then we're going to subtract off the part that they paid 15% tax on.
I've got a question.
Mm-hmm.
In Ms. Daphne's video,
Mm-hmm.
on the last part, she did not subtract the $18,550 again. She just subtracted the $75,300.
Well, yeah, you will. I'm trying to think about why you would or wouldn't.
Because that $18,550 is already included.
It's already included in the 75,300, you're right. So yes, you do not put that in there. My brain took a bird walk, sorry. Because we only took this off to get it out of this.
Right.
But then once we took that off, that amount included that 18,550 to start with. So we don't take it out again, you're right. I think my brain leaked. So let's see what I get. Let me change that. And you do get the right answer, which is $13,417. So that's the amount of taxes that she actually pays. And I've got that in my notes, but for some reason I had put that last part on again.
I still got something different.
That's what I thought.
Okay, let me see what you typed in. Let me double check mine again. enter it one more time.
I think I figured it out.
That answer was right. We figured it
Okay.
out.
Did you transpose some numbers? Because that was what I was afraid that I did.
Instead of 87,500, I was doing 87,550.
Oh, okay. So it should be $13,417.50. Okay? Now I'm going to go back for just a second. This was not part of the first problem, but just for the practice of doing the taxes. Karen is single. Let's calculate Karen's taxes just because. So Karen's taxable income is $23,400. And the way we'll calculate her taxes is up to $9,275, she pays 10%. And that's because she's in the single bracket. And then her $23,400 is less than the second bracket. So she's going to pay 15% of this actual amount. Minus the part she already paid taxes on. So there's her tax calculation. So she's only going to pay $3,046.25. That's what she's going to need to pay. Okay? So the process is the same regardless of which filing bracket you fall in, married, single, married filing separately, or head of household. But it's a process to actually calculate the taxes because you have to keep subtracting off what you already paid taxes on. So let's try one more. We have here that Pat is the head of a household. And she has a dependent child, one. And her adjusted gross income, which is what she starts paying taxes on, her adjusted gross income is $57,000. So when we do her taxes, we're gonna have to go out to that very last column. Excuse me? The head of household. Okay, we're gonna use the last box. Now that was her adjusted gross income, but she's got some deductions. She has a standard deduction of $9,300, and then she has two $4,050 personal exemptions. She doesn't have to pay taxes on that part of it. So in order to calculate her taxable income, we take her adjusted gross income and we subtract her deductions. And keep in mind that this is a little bit different from what we did on the problem with Sarah and Marco, because they gave us Sarah and Marco's taxable income, so they'd already figured their deductions. This time we're finding the deductions. So with those deductions,
So are you subtracting the 450 twice because she has the child?
yes.
Okay.
So her taxable income is not $57,000. Her taxable income is $39,600. Excuse me. $57,000 minus $9,300 for her standard deduction. Okay, yeah, it's easy to do. As I was doing my notes, I kept forgetting zeros or forgetting to put in decimals sometimes, so you have to kind of watch yourself. So this is her taxable income. That's what she actually pays taxes on. Or he, it says he. He also is entitled to a $1,000 tax credit. Now notice I didn't do anything with that just yet. Okay? We don't do anything about that till the end. But we do need to remember it's there. We have to calculate his taxes first. So now we'll calculate Pat's taxes. So according to the tax table, up to $13,250, he's going to pay 10%. Plus, he's going to pay 15% of anything up to $50,400, but this amount is less than that. So rather than use this $50,400, we're going to use the actual taxable income, which is $39,600, but we're going to subtract off the part he already paid taxes on. Yeah. Now that we don't need the table. So there's his tax calculation. And I get $5,277.50. Is that what you get?
Is the tax credit that they mentioned in the column, is that the tax credit that he gets for his dependent child, or is it separate?
This is not a tax credit. This is actually a personal exemption.
Yeah, but on the very first page where it has the definition for tax credits, it says the amount by which your total bill is reduced.
Exactly.
The common is $1,000 per child.
It's $1,000 per child. I think sometimes that's like the earned income credit. There's a worksheet they use to file it, but this is just a flat $1,000 tax credit
So
because he has a child. If he had two children, his tax credit would be $2,000.
Okay, so.
That's different from this.
The problem says he's entitled to $1,000 tax credit,
Yes,
so we'll take that off. But
yes.
is there an additional, because she didn't show that child tax credit in her column on the video.
I noticed that too. That's why I was gonna be sure and do this one
Okay.
with us. And the distinction I want you to make here is, this is her entire taxable income right here. But this is a credit toward paying those taxes. That's what a tax credit is. It's not the same as a deduction. That's why we didn't take it over here. These are exemptions or deductions. But this is a tax credit. So it's, okay, you owe us this much, but we're gonna not make you pay $1,000 of it because you have a child. Does that make sense?
Yeah.
So the amount that Pat is actually going to pay or going to owe the government in the end is gonna be $4,277.50. Okay?
So I'm still kind of confused because it says that he's also entitled to $1,000 tax credit. Is that tax credit separate?
It's separate.
So is there another $1,000 they take off for the child?
No, they don't take it off of his adjusted gross income. If Pat didn't owe as much as $1,000, he might not get that $1,000. Like if his tax bill was only, let's say, the $277.50, he just wouldn't owe any taxes. He wouldn't get the extra money. Okay?
So in the problem, where's that $1,000 coming from if not from the child?
It does come from the child, but it's not the same as this.
Yeah, I mean, I'm talking about like,
I think she's thinking the $1,000 he's just getting, and then he owes another $1,000. He's owed another $1,000 for the child. But the $1,000, I think, is the child credit.
It is.
It just comes off the end.
It just comes off at the end rather than as an exemption.
I guess I was just confused. I didn't know if I was supposed to calculate $1,000 tax credit for the child plus the entitled $1,000 tax credit that it mentions, because it doesn't specifically say that that credit goes
To the child.
to the, because of the child.
The only clue that you've got that is for the child is when we go back to that first page and we talk about tax credits. The most common since 2003 is $1,000 per child that you have.
Okay. On the practice problems, and it says that they have a dependent child, do we automatically take that off, or do we wait for it to actually tell us that they,
Not everybody gets that $1,000 per child.
okay.
Okay.
I didn't take it off on our practice problem
Yeah, you shouldn't. Unless it tells you specifically you have a tax credit, you don't take it off.
Okay.
And the reason you don't is because, for example, Pat has dependent children, but if we go back to Sarah and Marco, let's say. Okay, Sarah and Marco, let's suppose they're married filing jointly, but they had a child. Okay? Sarah and Marco probably wouldn't get that $1,000 tax credit And the reason they wouldn't is because of their combined income, probably, and I'm not sure, because I don't know what the cutoff income is. But I'm guessing that with a taxable income of $87,500, they probably don't qualify for that credit.
Okay.
Only people that make below a certain amount actually get that child tax credit.
I think everybody gets it.
Nah,
You get it?
I don't remember.
No, like if you, yeah.
If you make over a certain amount, I don't think you get it.
So in the rest
I
of,
just don't know what the amount is.
in the rest of the practice documents, I haven't looked at them. I don't know if they're anything like this. But if they mention it to Hal, could we not?
You don't automatically give them that tax credit because it doesn't say that they have it. Okay? It has to say they have it. And I'm guessing that if Sarah and Marco had a child, they wouldn't qualify for it because their income's quite a bit higher.
Here, child tax credit can reach your tax bill as much as $1,000 per child if you meet all 7 requirements.
Uh-huh.
They have to have age, relationship support, exercise, citizenship, length of residency, and a family income.
Right. And family income's what trips a lot of people up because it's not really all that much. It's not that high an income. Okay, so bottom line is not everybody gets the $1,000 per child tax credit. If the problem doesn't mention it, you don't do anything with it. Okay?
7,000 for single, 10,000 for widow, and under 10 if you're married, close to
Okay, well then probably if Sarah and Marco had a child, then they would have qualified. I wasn't sure what the income was because they change it every year. And I haven't had a kid in years, so I don't worry about it.
If I don't get it, I don't even want to look at it.
Right.
Knowing that new information, is that us to apply them to jobs or just get that?
Unless it specifically tells you they have a tax credit of any kind. There's also other kinds of tax credits, it's not just for children. Now, unless it tells you they have a tax credit for any reason, then you don't worry about the tax credit. The thing you remember about tax credits though is that if you do have one, it comes off the taxes at the very end. It is, you don't deduct it from your income to find taxable income, okay? The other kinds of tax credits you might, since we're talking about it, there's a tax credit for having, for buying one of the new hybrid cars.
Yeah,
You get a tax credit for, I think it's like 3 years.
yeah. Same thing with like solar.
Substantial credit, yeah.
Yeah, it's a nice credit. You can get one for buying energy efficient appliances.
I left those when I bought my new appliances,
Right.
and when I bought our new heat pump, and when we bought new windows and doors. We got a tax credit for
Yeah,
all that.
you can get tax credits for those. So there's all kinds of tax credits. Okay, moving on. FICA. FICA, Federal Insurance Contribution Act. FICA taxes are used to pay Social Security and Medicare benefits, primarily to retired people. Yes. I missed one? Oh, okay, number 5 on the examples. Okay, yeah, I know why you want to know about this one. Number 5, after you calculate Jessica and Frank's taxes, they're married, they have no dependents. And it winds up that their taxes is $674 when all's said and done. Because you take their adjusted gross income by taking their $180,000 because they have $90,000 each, minus their standard deduction, minus a deduction for each of them. Their taxable income was $159,300, and then their taxes turned out to be $674. And then the fifth question says, do Jessica and Frank actually pay a marriage penalty? A lot of us have heard about the marriage penalty, but we don't understand what it is. And the same place that you can find what that child tax credit is, you can actually Google that and find out what a marriage penalty is. A marriage penalty is when a married couple has to pay more in taxes than they would if they pay as two single adults. Okay?
I think in Oklahoma, Florida, you still took out,
The 18,550.
Yeah, that's it.
everyone took out.
Yeah. I'm sorry, I've got the right answers, but I kept doing that. Okay, it goes out there, but, not here.
Yeah, I got $31,000.
And then this one doesn't come out here and here either. I wonder if I got my numbers right on that. Let me double check my numbers.
I got 31,589 for their tax bill. So if they only paid $600 in taxes, I need to get their account.
Yeah, really. I think that's because I did actually put that in. I messed up.
Progressive tax rate, that to make more money and pay more taxes.
Kind of defeats the purpose, doesn't it?
Yeah, yeah. It's like a good thing.
Oh, wait, no, not that one. Yeah, I marked out the right part. Is that what you got?
He didn't put a one in front of his eyes.
Ah. I was thinking that was awfully high. $31,000?
Yeah.
31,589.
Now, as to whether or not they pay a marriage penalty, let's do a little refiguring. Let's assume that they had to file, and you don't use married filing separately, you're gonna use the single rates. And remember, each one of them makes $90,000. So we take off their exemptions. Now they can each claim only themselves, they can't claim each other. So their taxable income is $79,650. Okay? So that means that what they're gonna pay is 10% of the first $9,275. Plus 15% of the next $37,650. minus the 9,275 plus the whole entire amount, because the 25% number is 91,150, so this will be the last part. And it's gonna be for the whole 79,650 minus the 15%, which was 37,650. So each one of them pays $15,683. But there's two of them. So each one of them has to pay that amount. So in total, if they were filing as single adults, they would pay $31,367.50. And if you compare that to what we calculate for married filing jointly, that was $31,589.50. So which way do they pay more? Are they paying a marriage penalty? Actually, they are.
Yeah, I think $220
They pay a little bit more. They pay $222 more because they're married filing jointly. So they pay higher taxes because they're married and not two single adults.
Is that done on purpose? Like, is the government doing it on purpose?
I don't think it was necessarily intended to be on purpose, that it was necessarily intended to be a marriage penalty built into the tax system. It just turned out that way, and it doesn't really work for everybody. A married couple that has a smaller income doesn't pay a marriage penalty. But the higher your income is, the more likely it is that if you're single and don't have any children, you're gonna pay a penalty in the long run in your taxes. Okay? Don't assume that it's like that for everybody, but it actually is for this particular couple. Find my place again. Okay. So now we'll talk about FICA taxes. This is what it's used for, and it is primarily for retired people. It applies to all of your wages, every single bit. All your wages, tips, and self-employment income. Notice it doesn't apply to your dividend income. Those are not wages. So interest income and dividends are not considered. But there's also no exemptions and no deductions when you pay FICA. Okay? This is how you calculate FICA taxes. Your FICA taxes are for Social Security, because there's two different categories of these. Social Security is 6.2% on the first $127,200, and that what that means with employer matching is that you're going to pay that 6.2% on your income, and so is your employer. So it's actually being paid in double. Medicare, on the other hand, is a lot lower tax rate. Medicare is only taxed at 1.45% on the first $200,000, and then 2.35% above $200,000. And again, that's with employer matching. If you are self-employed on either one of those, you have to pay your own plus the employer match. So you're going to pay double if you're self-employed. You have to pay twice. And that's what that last sentence says. Self-employed have to pay the employer part because they are employing themselves, plus they're paying the employee share. So they get hit doubly hard.
And that's still only on earned income.
That's only on earned income. It is not on interest. It is not on dividends. Okay? And there are no deductions. So let me keep this handy so I'll have the percentages to refer to, and we'll do some calculations. In 2016, Jude earned $26,000 in wages and tips. Calculate her FICA taxes and her total tax bill, including her marginal taxes. Okay, FICA taxes . 0.062 times, let's see, she's going to pay 0.062 on the entire 26,000 because you pay it on up to your first 127 plus thousand. So she's going to pay it on the entire amount.
Do you mean the 0.765? Is that the FICA?
No, she's single and takes a standard deduction, but she has a job, she waits tables, and it says calculate her FICA taxes, okay? This is only the Social Security part of it.
Yeah, because in the video, that one took her income and then
Right.
times it by the 765.
Well, let me show you why you can do it that way. So we can do this one, and that gives the Social Security amount. And she's going to pay 1.45% or 0.0145 times the same amount. And that's going to be for Medicare. So you can do two separate calculations and add the result. But it's easier since the only thing that's different is the two different tax rates. It's just easier to add the 0.062 plus the 0.0145. And that's where the 0.0765 comes from. So that way you don't have to do a bunch of separate multiplications. So she pays $1,989 in FICA. And then it tells us to also calculate her marginal tax bill so that we can find her total tax bill. So she is single and takes a standard deduction. So looking at the tables, she is single, and she's gonna fall in the first two tax brackets. So her taxes are gonna be 0.10. Oh wait, I forgot to do her deductions. Wait, sorry. She has 26,000 minus 6,300 and minus 4050. Because we need her adjusted gross income for her taxable income. So her taxable income is 15,650. Get the calculator out of the way. So it's 10% times, the first bracket is 9275. And the second bracket is 15% up to 37,000, but she doesn't have 37,000, she only has 15,650. Minus the part she already paid taxes on. So she pays $1,883.75. And that's her marginal taxes. So her total tax bill then is $1,989 plus $1,883.75. Which is $3,872. $3,872.75. Okay? Any questions on that one?
What she need to do, the overall tax rate?
Yes. Because the last question here says, what is her overall tax rate? And that includes both FICA and income taxes. Okay? Well, her total tax bill is $38,7275. And if I adjust and make it into a percentage, that means I need to divide it by her original gross income, which is the 26,000. And that means her tax rate, her overall tax rate, is 14.9%. So she pays almost 15% of her gross income in taxes. Okay? One more time? There you go. Our last category is going to be capital gains. That help? Capital gains taxes is taxes on the profit made from selling items at a higher price than what you paid for them, like stock or property. There are two different kinds of capital gains taxes. Short-term capital gains is on things that are sold within 12 months of when you bought them. So if I had a lot of money in January and I bought some stocks and got a good price on it at the end of the year, and in December I sold those stocks, that's short-term capital gains. If I paid $1,000 for the stock and then I sold it in December for $3,000, that's $2,000 capital gains that I would have made. Long-term is the profit on items for more than 12 months. So basically a year is your cutoff on that. That would be like if you bought maybe a piece of property and you held on to it for several years, and then they decided to put a subdivision out there and you said, hey, I'll sell you mine. You're gonna make quite a bit of money probably, because in the course of a few years your property is going to appreciate. But that would be long-term capital gains. Capital gains are taxed at lower tax rates than ordinary income. And the reason for that is because you're encouraging investment in businesses and products that involve risk on the part of the investors. It's 0% taxes on capital gains when your income is in the 10 to 15% tax bracket. So you're not going to pay capital gains taxes if you're basically a working stiff. You're going to have a silver spoon in your mouth just about to have to pay capital gains tax. And it's 15% for all the higher tax brackets. Sometimes the gains are tax exempt. And the one example I have here is capital gains on your home. Now, if it's your second home, it's not going to be tax exempt. It has to be your primary residence. But if you sell your home, most of the time you don't have to pay any capital gains taxes on the amount that you profited from selling that house. you sell your yacht, you're gonna pay some capital gains taxes. So for example, here we have 2016. Serena was single, and she lived off of an inheritance. Somebody left her a bunch of money. Her gross income consisted solely of $90,000 in dividends and long-term capital gains. So somebody probably left her some money and some property, and she sold the property, and she had some investments with that. Maybe they left her stocks and bonds. So she made $90,000 off of that. She must have had some rich relatives. She had no adjustment to her gross income. But she did have $12,000 in itemized deductions. Now, always, if you get an itemized deduction amount, always compare it to the standard deduction for whatever tax category you're falling into. Because unless your itemized exceeds your standard, you don't take the itemized, you take the standard if it's higher. So you're always going to need to make that comparison. So she has $90,000. She's single. It doesn't mention any children. So we're going to assume that she's going to pay the single tax rate. And she's going to go up to the 25% bracket probably. But she does get some deductions. So we're going to take her $90,000. And we're going to, now she has $12,000 in itemized deductions, which is higher than the $6,300 she could take as a standard. So we're going to give her the $12,000. And she still gets her personal exemption of $4,050. So we're going to find her taxable income. And her taxable income is $73,950. So that is going to put her into the 25% bracket on the taxes. So the way that we're going to count her taxes, 10% of the first $92.75 plus 15% of $37,650 minus $92.75 plus 25% of the whole $73,950 minus the $37,650.
This is 0 over 10.
It won't matter, but I'm in the habit of putting it in, so I did. So her marginal taxes are $14,258.75. So she owes $14,258.75 in income tax, but she also has to pay FICA. Wait, let me. No, she does not have to, because it's all investment incomes and, long-term capital gains. So no, she does not. She doesn't have to pay FICA.
In the video, she done is completely different.
Oh, yeah, she took the 73,650 and then minus the 37,650, and then times that amount by 50%.
Yeah.
To get the five,
And then get this, about 6,000 times.
I don't-
You see,
But
that's
when
what
I
I
added
added.
it, that like, but when I re-added it,
It becomes, yeah.
and then it comes back to the 5,445.
Tell me again what she did.
She did what you did with the 90,000 minus the 450, and the 12,000.
Uh-huh.
And then we got the 73,650.
650 or 950?
73,650, or 950.
950.
So she's not wrong on the video too. The list, she wrote down 79,000.
Oh, okay, she transposed her numbers.
Yeah, so,
Okay.
and then she subtracted the 37,650, which she said was not taxable. And we got that amount, and then she times it by 15%.
I overlooked something. Okay, no, she did that correctly. I'm sorry, my bad. I wasn't paying attention to the definition. It's all my bad. You don't pay anything for any of the income in the 10% and 15% brackets. So that's my bad. I messed up.
So that's where the 37,000 was.
Yeah. She doesn't pay that. And she doesn't pay this. Because it's long-term capital gains and dividends, so she pays 0% of the first 37,650.
Can you move your calculator?
Yeah, let me just put it down for a second. So she doesn't pay anything on the first 37,650. Because that's how capital gains works and dividends works. She pays 0 for the first two tax brackets. So you'll start at 15% of whatever everything over those first two brackets is. And that's why you subtract off that 37,650.
Okay, so do you rewrite it?
Actually, this is all there is,
Okay.
right here. So her tax bill is going to be 25% of her total income minus the first $37,650 of it, which is tax exempt. So she pays $90,075.
Okay, what do you use the 15% on the 25?
Yeah, it's a flat tax.
That's the flat tax, yes, it's 15. I put in the 2, it should have been 1. It's not income tax, it's just a flat tax. So it's 54.45. okay? I'm glad you guys watched hers. Actually, I should be paying more attention to my notes because that's exactly what I did on my notes. I just didn't do it on the paper.
Hey, it's Monday.
Yeah.
Don't forget the overall tax.
Somehow I got let me redo that calculation because I got a different thing on what and I don't know why I did. She had $9,000, $90,000 minus 37,650.
Where do you get the 37,650?
That's where she doesn't have to pay any taxes because it's all capital gains and dividends. The first 37,650 is tax exempt. Okay? Plus, she has a $1,200 itemized deduction. Let me just do them all at once. And then she gets her personal deduction, which is $4,050, and I'm wondering, I took that off. So what she actually pays taxes on should be $36,300. And she should pay that at 15%. And it should be $54.45. And then the last part of it, what is her overall tax rate? You take your $54.45 and you divide by her annual unadjusted income of $9,000 or $90,000. And that's 6.05%. Which we'll call 6.1%. Are we in agreement now?
She got 7%.
Well,
She transposed some numbers. When she, yeah, I think her video said 79,350. 79,650, so she didn't do her math right. Actually, the way she may have gotten what she did, I gave the personal exemption because I think you still get personal exemptions even on dividends. And I don't think she took off the $4,050. So that's probably where she got the 79. Make sure I didn't read that wrong.
No, I think she did her math wrong.
Yeah.
I'm pretty sure.
So I mean, she told us to do subtracted it, but then she got 79,000.
Okay, so she said to do it, but she didn't do it.
She did.
Okay. Because I was going to say, you're supposed to get that exemption regardless. Okay. We're done with taxes. I wish we really, truly were done with taxes.
Okay, so what all is due tonight, since we only have a few minutes left?
Nothing.
Nothing?
Nothing is due tonight. 5 and 6 are both due on Wednesday night. Now, I'm gonna start 5, we probably won't get finished, but the idea behind this last section is really, really easy. So let's talk about net income. I just want to get the terminology out of the way. Net income, this works the same as if you're a person or you're a business. Your net income is whatever you take in minus whatever you had to pay. And I mean had to pay. It's not that discretionary candy bar unless you budgeted it. It's things that you pay like bills. Okay? So here's the definitions that really matter to you. You have receipts. Receipt comes from the word receive. So that's money you get from wherever you get it. It doesn't matter where you get it from. It's money that you get, money paid to you. Your outlays should make a certain amount of sense because it's money that you spent. Money that you paid out. Your net income is always receipt minus outlay. What you take in minus what you have to spend. Whether you're a person, a business, or whatever, if you have a surplus, that means you had positive net income. If you're a business, your total surplus is called your profit. You made money. Now, if your profit is negative, in other words, if your net income is negative, that's referred to as a deficit. Or in business, it's called a loss. Negative profits is the same as a loss. Please do not confuse deficit with debt. It's not the same thing. Debt is the total amount of money you owe to lenders. And that may result from accumulated deficits over many years. But debt is the total amount of money that you owe somebody. Deficit is when you have negative net income for one particular year. Now, if you keep having negative net income year after year after year, that means your debt's piling up. So just as a quick example, your gross income last year was $40,000. Your expenses was $20,000 for rent and food, $2,000 interest on your credit cards and student loans, $6,000 for car expenses, and $9,000 for entertainment and other little expenses like your Starbucks coffee and your donut for breakfast and candy bar, all that kind of thing. Okay? Your receipt in this case, since we're wanting to find net income, that's equal to what you took in minus what you paid out. Minus your expenses. Your expenses were $20,000 plus 2,000, plus 6,000, plus 9,000. And you paid $800 or $8,000 in taxes, well, that's an expense. You had to pay it. So that's 22, 28, 37, $45,000. I'll check my math in a second. Y'all check too. So $4,500. Or $45,000, I'm sorry, there's a big difference there. Now you took in $40,000, you paid out $45,000. So you have a deficit of $5,000. Okay, now that does not mean you have a debt of $5,000. What that means is you took in this amount of money, but you had to pay this amount of money, and you actually maybe had to dip into savings or sell something to get extra income to be able to pay this additional $5,000. That doesn't mean you're in debt. This is just money you took in that particular year, and then you paid out this much money in that year. So it's not a debt, it's a deficit. Okay? Now that's the essential idea behind everything we're going to talk about in this last section. If you haven't watched Miss Dabney's lecture, please do. This is a relatively short section. I'll do the rest of the examples. In fact, I may go ahead and do my own video and have it up there for you if I can get it done. But be sure that you read through these, and then we'll take questions next time. And I'm also going to post the answers to the study guide pretty soon, because I know a lot of y'all already started working on it. So y'all have a great day. Go out and enjoy some sunshine this afternoon. I think I would get up today. No, I think I'm moving in Friday or something.